Hello, welcome everybody. Thanks for joining us this morning on this webinar that we are hosting with our good friends at Capitalise. Really tough time for everybody right now, has been for wow, what seems like an age, but yeah, for most of this year. And one of the things we're really conscious about at Nefos is making sure that our clients are looked after, businesses are able to, to survive and thrive in these times. And one way to do that is through funding and recovery in your business. So yeah, delighted to welcome Capitalise with me today. I'll do a quick introduction of myself, and then I'll allow Rory and Kip to talk through their roles. So my name's Joe. I'm the founder and MD at Nefos. We're a business advisory firm working with many clients on trying to help them scale and grow their businesses through advisory. And we naturally do the typical accounting stuff, VAT, self-assessments, etc. as well. But our main focus is business advisory and real-time live analysis of data for clients. So that's why we really love working with Capitalise, because it really gives us that opportunity to use funding and recovery as a way of advising our clients as well. We'll go on to some slightly more detail in a second. So Rory, do you want to give a quick intro to yourself?
Hi everyone. Yeah, I'm Rory. I'm one of the partnership managers here. My role is to work closely with Joe and other accounting firms to ensure that they can be the best that they can be at helping their clients, both with funding and also recovering invoices, obviously key at the moment for building resilience. Kip, you want to introduce yourself?
Yeah, cheers, Rory. So I'm Kip Noble. I'm the head of lender relations at Capitalise, and I also work within the structured and secured team, dealing with the more complex funding needs and solutions. So sort of in the M&A space and more corporate finance side of things. Background, used to work at Lloyds Bank for sort of 7-8 years in the mid-corp sector. So know the market, quite well. So yeah, thanks for having us, Joe.
Thanks, Kip. Yes, we've gone to the next slide. Yeah, thank you. So our agenda today, very simple, but we just want to give you a quick introduction to the webinar, a bit about who Nefos are and where we've come from on our journey, a little bit about Capitalise and what they are looking to do. And then Kip will give us an overview of the lending market at the moment. Lots of things going on, lots of constant changes. This slideshow got changed, I think, not so long ago, given all the changes, and could probably have been changed this morning if we'd really kept our eye on things, the way it is at the moment. And then a bit of a deep dive into other aspects of finance, because naturally CBILS is one that dominates, I think, but there are also other deals going on. And then Rory will give us an overview of the recovery product that Capitalise have launched quite recently, actually, to really again build resilience for firms. Because it's not all about debt. It's also about, can we recover some of the money that we are owed by our customers. So and then we'll do a quick Q&A at the end, any particular questions, and we'll go from there. So yeah, who are Nefos? So we were founded in 2014. My background's industry. I worked in manufacturing businesses as I qualified as an accountant. And when I set up the business in 2014, the focus was really from day one around business advisory and FD type work. Naturally, as a business, when we started to scale, we took on lots of compliance-based VAT returns and things to grow the business. But our main focus of our team is around the business advisory piece. And we try and offer business advisory from the bottom all the way to the top. We are a team of 9, and we've got just under 200 business clients. Our team are made up predominantly of people that haven't worked in accounting practices. We like to focus on the commercial aspect of what we do, and therefore our hiring has been typically through industry-based candidates. We've been nominated, not won yet, unfortunately, for multiple awards, but that 2021 is definitely going to be our year. And we're 100% digital. Our focus is around using digital tools to improve efficiency and accuracy of data. And that's not just for ourselves, but for our clients. We want our clients to be able to be efficient in the data that they use, and therefore be able to believe the figures that are coming out of their systems. We, like I say, 100% digital. We don't take paperwork. Everything's done through receipt scanning apps and through Zero. And yeah, our focus is really around really getting the small businesses, especially in times like this, into the digital world. Like I said, our focus is on business advisory and helping business growth, and we use tech to do that. So that's where the tech-driven growth advisors come from. So yeah, that's a little bit about Nephos. Rory, do you want to give us a little bit about Capitalise?
Sure, thanks for that, Joe. Yeah, so Capitalise is an advisor-led funding platform that helps your business get the right funding at the right time and at the right price. It's a good match to work with your accountant, as our platform will unlock the full market, and your accountant will be able to prepare the necessary financials and give you that professional advice to make sure that we get the right sustainable solution for your business. And that's what we do here at Capitalise.
Great, thank you, Rory. So, Kip, over to you.
Yeah, cheers, Joe and Rory, and thanks for having us on. So, what I'm going to go over is a little bit about the CBILS and bounce back loan marketplace, just because it's so important right now. It dominates the vast majority of lending that we're seeing within the SME and mid-corp sector. And then I'll do a little bit of a deep dive around certain products which we feel are going to be the most crucial at sort of this time, and also about sort of trading up post CBILS, because while CBILS continues to be sort of extended in terms of the deadline, it will end at some point. It simply has to. So it's important to understand where the market's going to be and sort of what products are realistically going to be available within the marketplace. So initially, sometimes we feel like the world has irrevocably changed over the sort of the last year, but it's important sometimes just to take a bit of a breath and understand actually that it has only been 8 months since that initial lockdown. It's been well under a year. So yes, it's been quite a manic sort of 8 months, so much change, so much to understand. It's important to sort of look back and realize that it's actually only been such a short period of time, and things now, you know, with the positivity that we've had this week in terms of the vaccine and various other things that have sort of come through, you know, in the market, that, you know, we are seeing sort of light at the end of the tunnel, and we will get back to, you know, some form of new normality in the near future. So if we sort of think back to January, February, we had a very, very open lending market. There were over 365 active lenders in the marketplace. It's a huge, huge number, which were growing all the time. Now, clearly, that took a very drastic turn come sort of the 21st of March, I think it was, looking back, when we first entered lockdown. We were in a period of huge uncertainty in the marketplace, and lenders do not like uncertainty. So they completely retrenched from the market. They took their time to try and understand the risk, because we simply didn't know anything about what this, you know, disease was going to actually, you know, do to the economy, political, social, and clearly it's had a greater impact than anyone would have forecasted, you know, in January, February. So huge impact. Some lenders completely retrenched, and a lot of lenders simply haven't even come back into the marketplace. So at that point, you know, the government came in, had to intervene. So they came in with the CBILS, the bounce back loans, vast amounts of schemes and grants which have been put into place, which have been ongoing. So clearly we've had the news that the furlough scheme is going to be extended to the 31st of March. There are lots and lots of other sort of support packages out there. So it's really, really important that you have a look and understand what is available to your business. But if we look at this from sort of a lender's perspective, clearly we're back into lockdown. Feels a little bit like deja vu, but it's important to understand that this is not where we were during the first lockdown. It is much more open. We have a much greater understanding of what we're dealing with, and because of that, lenders can price and accurately model risk much better. So the lenders have not retrenched back into the marketplace. We now have a very active and open market. So it's, again, like I say, it's just important to understand and have a bit more confidence in the marketplace in terms of if you do need debt, you can get it. The lenders are out there and they really are willing to support. This is not like it was in March, you know, March, April time, when lenders were just, you know, in panic mode, really. They were looking after their back book and just really trying to understand and make sure they could actually stay afloat. So we're in a very different, much more comfortable position. Obviously, there's still a lot of pain out there. You know, being in lockdown, it has huge impacts on lots of things, but there's certainly a lot more hope and positivity and optimism in the marketplace, and hopefully that's, you know, reflected in what you're also seeing out there.
And sorry
So-
to jump in there, Kip,
Yeah,
just a
right.
really quick one there. When you say that the market's open much more this time, we're talking general commercial lending as well as
Oh,
CBILS.
absolutely, yeah. So the commercial lending landscape has, like I say, changed. So clearly, CBILS and bounce back loans dominate that sort of unsecured as such lending landscape, but the commercial lenders are much more open. So we'll be going into invoice finance, secured and corporate finance in a bit more detail, which is where the commercial lenders are most active. And I'll go over sort of maybe how they've evolved a bit during COVID and where they are right now. But yes, the lending market, I'd say is 80% where it was pre-COVID. So it's taken, I mean, it went probably to about 5% in April, and now it's really worked its way back up, so that it is a lot more open and accessible for all clients. So really, really important to get back into the mindset of where we were previously, that if you need support, you can get it.
Great,
So,
thank you.
Yeah, no worries. So if we have a look at sort of the bounce back loans, which is where the majority of clients have taken funding, up to 50,000, you can only have it once, one per group, 100% government-backed guarantee. It's just purely a self-declaration from the director or shareholder. Just also important to just actually read and understand the declaration, because you are signing quite a few key points to understand. So yeah, just important that you have a look through that. And then we've got the CBILS, which is where at Capitalise we've been focusing on, because obviously bounce back loan, because it's just a self-declaration, you can go direct and it's exceptionally easy and straightforward just to get. So CBILS, there are about 110 lenders in the marketplace, of which we've got about 40 at Capitalise. They're from 50 to 5 million in terms of debt, no PG up to 250k. You can have it across multiple lenders across all products. So it's important to note with CBILS, it's not just a term loan. You can have it across asset finance. You can have it across secured, invoice finance, and working capital revolving credit facilities. So it's across all the product sectors. So it's important to have a look at all the opportunity within it. It is a completely and utterly unique product. It's a once in a lifetime win-win scenario. There are no fees, no cost whatsoever for taking this product. So if you've taken a bounce back loan, if you've been sort of knocked back by your high street lender and you've lost that confidence in terms of thinking you're going to get the CBILS, if you were viable in 2019, so that's a profit-making business, you are likely to get it. We've got an acceptance rate at Capitalise of nearly 80% for all CBILS applications in terms of offers from the marketplace. That has sort of grown as the high street lenders have sort of really taken their sort of chunk of the marketplace, and now we're looking at more of the alternative lending space, and they are providing offers. So like I say, we've got a near 80% acceptance rate, and it really is so simple and straightforward. The information required is very minimal, and the time sales in order to actually get offers is, it's 5 to 7 working days realistically from the information being fully received to either getting an offer or sort of a declined feedback. But like I say, we are getting nearly 80% offer rates. So if you have been knocked back by the bank, you have taken a bounce back loan, and you're thinking about potentially taking more, now is certainly the right time. Just because December it comes around very quickly. A lot of businesses, accounting firms are all shut for that sort of 2-week period, and January is an exceptionally busy time for most accountants. It's the self-assessment tax return and things like that. So very, very busy month. So I'd look at it sooner rather than later, and really just have a good emphasis on that, because like I say, it's a win-win situation, and we don't know where we're going to be in 6-9 months time. So there is no loss to actually applying, because if you take it now and decide in 11 months time that actually I was able to survive on the cash I had in my account, and we managed to retrade much quicker and we didn't need it, you can just pay it back and there's no cost at all. So ask yourself the question, why wouldn't you take it? And actually, I've never had a good answer to that yet. So really, really important just to have a look at that and understand. And then, like I say, we've got the commercial lenders, and we'll be going over that in a little more detail. So in terms of the changes, again, I should have changed this slide. This was something that we've had so many changes that have come through. So the deadline, you can very much ignore that, is the 31st of January now. So you can see how much we've sort of been utilising this in the marketplace. So yeah, the deadline is 31st of January. And in terms of the changes in the market, you have the bounce back loan scheme, which is now pay as you grow. So terms are being increased from 6 to 10 years. You can have interest only periods, and you can also have repayment holidays. The reason for that is just to sort of ease a bit of cash flow pressure once these loans are due to be repaid, because there is a bit of worry in the marketplace that if suddenly every single business who's taken a bounce back loan starts having to repay that capital over only a 5-year amortization period, it is quite cash flow intensive, and we don't want those businesses to suddenly have that impact in terms of cash flow. It's also why sort of CBILS, they're looking to extend it up to 10 years as well, and that's something that's probably going to be looked at shortly. But again, a lot of this is reciprocal, so most of it, if you have taken it, they will probably reach out to you and ask if you want it, because it's the benefit to everyone, really.
Can I ask a really quick question on that point? The term increase, is that an automatic increase on loans that have already been taken, or is that something that a business would need to apply for?
They're probably going to need to apply for, so I doubt it's going to be automatic, but again, it's something that's been put through by the BBB and government, but yet to be sort of fully processed in with most of these lenders. So 90% of all bounce back loans have been done by the trading banks, so they have a lot more flexibility in being able to adapt and change already provided loans rather than the alternative market, where it's a little bit more difficult because they've got very set process. So yeah, it's probably something that's, like I say, is going to be looked on a reciprocal basis, and when it's probably all finished, because we've still got 9 months really until they start having to be repaid, in terms of taking out sort of 6 months really in terms of it being repaid. So there's a bit of time until we need to have that fully sorted. But yeah, it's something to certainly speak to your bank or lender about in terms of look into it, because if you need that sort of, or want a bit of more cash flow support, it is out there now.
Great, thanks.
No worries. So the commercial lending landscape. So like I said, during the first lockdown, it took a significant hit, and it's perfectly understandable why that happened. They do not like uncertainty. They need to look after their back book. They are, lenders are businesses themselves, and they need to obviously make sure that they're viable in order to actually lend out to other businesses. So yeah, they did take quite a significant hit during this time, just like everyone, in terms of that sort of COVID initial impact. But they has increased substantially. It's opened right back up, and like I say, this lockdown is very different to where it was at the beginning. They're not a single lender, and it's important to note, not a single lender has retrenched back in the marketplace or suddenly massively changed appetites, LTVs, whatever it might be, due to the second lockdown. It is completely different. So where do we sit in the marketplace? Obviously at Capitalise, we can look at every single product, all debt, all businesses. So we've got full market access for all debt funding. So in terms of how sort of the marketplace has changed, so like I talked about, the working capital finance side of things is now just completely dominated by CBILS and bounce back loans. As you can appreciate, the need for no PG, the flexibility, the cheaper price, that interest-free period. If you can get it, why wouldn't you take it? So that's where that marketplace is now. So just going over a few of the others, trade finance, as you can probably imagine, has taken quite a substantial hit. Supply chains have been disrupted, and they still are, because you can't just look at it on the UK basis. With trade finance, you have to look at it across the entire world, and at different times, different countries have gone into lockdown, and it's very, very difficult to manage that supply chain finance when things are changing so rapidly. So that has certainly taken a hit. And again, it's taken another hit as the second wave has sort of come around, especially with Europe, which virtually all countries now, including ourselves, are in another lockdown. So that is quite a tricky product at the moment, trade finance, but it is still open. You can still get it, but it is slightly more difficult and complex than it used to be. Asset finance, we saw quite a lot of sort of patent and demand for this, in terms of sort of how it worked. So clearly during the first lockdown, manufacturers and various other businesses were shut. So if you wanted a new bit of equipment, you couldn't actually purchase it. So what we've seen now is clearly the construction, the manufacturing market is back open, and it's still open during this lockdown. So that sort of asset finance sort of issue which arose during the first lockdown simply isn't around. So we've seen sort of a lot of clients sort of buying new equipment at the moment to prepare for when they sort of retrade up post-COVID. And like I say, you can get asset finance through CBILS if needed, but clearly you can also get it through normal commercial lending. And then we're going to talk about property finance, invoice finance, and a bit around corporate finance. So property took a very significant hit during the first lockdown. So what happened was clearly valuations were unable to take place. So it meant that, which is obviously a very, very unusual situation. So they had to take what's called desktop valuations, which again lowered the sort of loan to values that they could provide across development, bridging, and the other products. So yeah, it did take quite a significant hit, but it's again, as we've moved through COVID, we're at a period now whereby we're back up to those loan to values we used to see. So we can do 80% loan to value across residential buy-to-lets. You know, we can get that 65, 70% commercial investment and 70, 75% commercial mortgages. So we are back up to where we were pre-COVID. It's important to note that within the property side of things, because it's generally speaking less risky, because of the security involved, lenders are much more willing to sort of provide support at this time. So development, which is a product which is designed for those property developers who either do ground up products or structural work. So it's not a refurb, it's a full development and structural works. We can get you up to sort of 70% loan to GDV or 80% loan to cost, depending on how it's structured. I mean, if you've done the actual land purchase itself, you can generally get up to 100% loan to cost. So that marketplace is still quite open. Generally speaking, the only changes now are that it's more difficult to get finance under £1 million, or if you don't have as much experience as is sort of necessarily required. Previously, there was a bit more flexibility around that, but now that's probably the only caveat I would say. If you really have no experience, you're going to have to pay for a contractor who has that experience. Or potentially, you know, if you're looking for something a bit more obscure, they're not going to look at more of those niche ones. But again, the marketplace is quite open. Bridging as a product, it's probably it's quite niche, so it's not hugely understood in the marketplace. So bridging is designed for those quick turnaround purchases. So if you need any sort of property, maybe it's an auction, or maybe you've got the right to purchase, so you're a tenant, but you need to complete on the purchase within 30 days. Bridging is sort of the perfect product for that. So generally speaking, you can get up to sort of 65, 70% loan to value across this product, and you can complete quite often within that sort of 2-week period. So it's really designed if you need to buy a property quickly. So like I say, auction or right to purchase or whatever it might be, or you've just got a real need to, you know, potentially inject lots of money into your business and you've got a great opportunity, but you've got no other means of sort of financing it. If there is an unencumbered property in the background, you can always use a bridging product to quickly release cash to inject that into the business for whatever need it might be. It might be a great opportunity to buy stock, or, you know, get a great deal on something. It's always out there, and it's quite a good sort of unknown product which provides really rapid access to a lot of cash. So the other side of the property sector, so commercial mortgages, which is very much dominated by the high street banks still, they are quite open for business. Barclays and Lloyds are comfortably the most active in this marketplace. NatWest, Santander are a little bit reserved, but it's very much still high street bank dominated. They're still quite comfortable lending 70%. They can even lend up to 100% loan to value in certain sectors, and that's sort of dental, vets, GP surgeries, which are very strong appetites. Agricultural is quite a strong appetite, along with some manufacturing areas. So always worth you know, coming to your accountant or speaking and coming through us just to have a look at what we can do, because it's not, you know, we're not talking 50% loan to values here. We are talking back up exactly where it used to be, and because of where the market is in terms of interest rates, you can get phenomenal rates now on these products. You know, 2 to 3% is not uncommon. So really, really open that place. Buy to let, yes. So obviously during the initial lockdown, this took a very significant hit. But what we're seeing at the moment is a massive uptick in this. So a lot of people who have taken CBILS bounce back loans and just haven't really needed them for the business, and now don't think they need them through their cash flow forecasting, are quite often actually using that to potentially expand maybe a side property portfolio that they have, or whatever it might be. So we have seen a huge uptick in this coming through Capitalise. And like I say, loan to values are all back up where they used to be. So there's really been a full change of completely dropping down to about 50% loan to value, now all the way back up to 80% loan to value for residential, or about 65, 70 for commercial. So yeah, really open now, and exactly what it used to be really pre-COVID. So invoice finance, probably the most misunderstood product in the marketplace, something which if you mention to some people, they will simply walk out of the room. It's one of these products where it's still got a reputation from, it's now about 20 years ago, where it was seen as a product of last resort, really, really expensive. And if you had it, you were basically about to go into liquidation. It is not that whatsoever. You'll be amazed at some of the high street and household names that have invoice finance. It is just a fantastic means to release very significant amounts of working capital into your business to either just maintain cash flow or grow or whatever it might be. It is a great product. You're always going to get, if you're obviously a B2B customer or a B2B business, you're going to get more through invoice finance than you can through, you know, an overdraft. You don't need tangible security. But why it's an interesting product and why it's so important right now is because clearly throughout COVID, businesses have been trading at sort of, you know, some 0% of what they used to be, some 20, 30, lucky ones have been able to actually grow during COVID. But most businesses have been trading at a much reduced sort of turnover level. In order to retrade back up to where you were post-COVID, it absorbs a huge amount of working capital. So it's really important to sort of have a look at that, understand where you are now, where you're likely to be in maybe 6, 12, 18 months time, and understanding if there are any cash flow gaps. If there are, invoice finance is a really, really good product to obviously release that working capital and ensure you actually maintain enough cash in the business to regrow up to that level and grow a lot faster than you could if it was just an organic basis. So invoice finance, there are 3 key products. You've got invoice discounting, invoice factoring, and selective invoice. So selective invoice is whereby you can just put through 1 or 2 invoices to an invoice finance provider if you don't need to really invoice finance the entire debtor book. Invoice factoring is whereby the lender takes full control over the credit control of the business. So typically speaking, it's used for smaller, less sophisticated businesses. And then you've got invoice discounting where you may maintain full control. And within invoice discounting, you can also have it as a confidential facility, which for some people is very important because then your clients don't know that you've actually got a facility. Because like I say, it's still got a slightly misguided reputation in the marketplace. So for some people, that can be very, very important. But I do think it's a product worth exploring. And you can use it through CBILS. So there are 2 lenders in the marketplace who are doing invoice finance and selective invoice through CBILS. So if it's a product you've been considering, now is potentially the right time to have a look because you can get the first 12 months completely free. So really, really interesting products at the moment, and something if you are looking to explore, now is a really great time because you can always pay it back within 12 months at no cost whatsoever. So interesting product and something to certainly consider, maybe if it's been something on the back of your mind or you've got long debtor days, new contracts, or whatever it might be. Then lastly is corporate finance. So this is sort of the M&A marketplace. So MBOs, management buyouts, management buy-ins, acquisition, or what's known as growth lending. So these are slightly more complex products, but this is a marketplace which has just rapidly taken off again. It's back to where it was pre-COVID and then some. And sort of why we think that's probably the case is a lot of businesses have extra liquidity in the marketplace that they're potentially looking to take advantage of. So a lot of businesses have been able to take up to that maximum 25% of 2019 turnover through their CBILS, and they've got excess liquidity and they're looking to take advantage of the market and just potentially look for an acquisition or, you know, fast growth or whatever it might be. But on the flip side, we've also probably seen quite a few business owners take the decision to potentially retire. They've probably taken a bit of a hit and they're thinking that, you know, now's a good time to, you know, to retire, whatever it might be, or they've struggled to see the light at the end of the tunnel. So a lot of businesses have made that decision. So that's where the management buyouts and management buy-ins have sort of come into play. But we've seen a really active sort of marketplace with this, and we've got the full access to all lenders. We've got the skill set and knowledge within our business to sort of be able to do this for all clients. So if this is something you're looking for, and these, you know, transactions are something you do, again, speak to Joe and then we'll certainly be able to help and just provide any advice that's needed. But yeah, really open marketplace for this at the moment. And yeah, that's me. But if anyone has any other questions, you know, speak to Joe, and then, you know, we can always pick up the phone and have a discussion. But I'll hand over to Rory to have a chat through our other side of the business, which is recovery.
Thanks, Kip. I've got a couple of questions, but I'll ask those. I'll put them all together and ask them at the end, if that's okay.
Yeah, that's absolutely fine.
Perfect. Thanks, Kip. So I'm going to talk about recovery, the ability to get paid on time, and if people haven't paid you on time, how you can use Joe at Nephos and Capitalise to get money into the business quickly to build resilience. Next slide, please, Kip. So late payments has always been an issue in the SME space. In fact, 42% of SMEs fear that late payments put their business's future at risk. And 90% regularly experience bad debts or other commercial disputes. Next slide, please. So the situation has always been bad, and it looks like COVID has made it worse. The percentage of unpaid invoices before the first lockdown was around 25%, and that peaked in May at about 40%. And actually, all too often you hear people just using COVID as an excuse not to pay on time. So I think moving forward out of the second lockdown, it's going to be really key to ensure that your contracts and invoices are set up in a way to get paid on time, but also if people are delaying, have the ability to get that money back into the business as quickly as possible. Next slide, please, Kit. So why don't many SMEs pursue legal action? So there's three key reasons. One is time. It's time away from running your business. You may feel that it's better to write it off than go through that, hefty legal process. The second key point is cost. You may be unsure of what the upfront legal costs could be. In fact, you may worry that the costs might outweigh what you would get back, which actually can happen. And the third key point is kind of around reputation. Maybe you've built a relationship with a large company that makes up a lot of your revenue, and you don't want to rock the boat. So you may not know how to go about it without risking your reputation or getting a bad name. Next slide, please, Kit. So what we've done at Capitalise, and Joe at Nephlos will be able to help you with this, is we've partnered with Escalate. They're an international law firm, and they've got a proven track record. In fact, they've unlocked £100 million worth of unpaid invoices. They're regulated by the Solicitors Regulatory Authority. And the really key point about this is they operate on a no-win, no-fee basis. So other law firms that can help with this service will claim to be no-win, no-fee. However, you may still need to incur barristers' fees and legal fees once it gets to court. Whereas Escalate, they're insured right up to the European High Court, meaning that they can go toe-to-toe with the bigger businesses, absorbing those legal costs up front, right until the point at which they win. And actually, even if you don't win, they'll give you free legal advice. So it's very different to the traditional method of recovery. And as a result, you get a quicker settlement because large businesses know that if Escalate are involved, that they will be able to keep going as high as necessary to win the battle, I suppose. Next slide, please, Kit. So now I'm going to talk a bit about sort of what this could look like in practice, what scenarios might come up, and what Joe will be able to help you with. So first key point is we can look to recover any invoice or contract above £1,000. This could be multiple smaller invoices that total £1,000 from the same contracted party. Usually you would look down this route once you've tried to reach an agreement with the contracted party, but it looks like they're just not going to pay you. Worth mentioning that you can actually look at doing this as far back as 3 years in the past. So you may have written off debt a while ago, forgotten about it. You can revisit it. Worth mentioning though that it's important that the contracted party has the ability to pay. So if they went into liquidation a while ago, we're probably going to struggle to recover those funds because the business assets may already have been stripped. But if you're confident that they can pay you and they're just using COVID as an excuse, then definitely worth looking at speaking to Joe, and we can get Escalate involved for you. More often than not, you'll look at this route when you're not going to continue working with the client. And final point on this is that your business needs to be registered and based in the UK, but the debtor doesn't need to be. So Escalate are insured up to the European High Court, meaning that they can look to recover, debtors from outside the UK and overseas. Next slide, please, Kit. So I think that's hopefully a useful overview on how recovery and the ability to get paid on time can build resilience and help you trade successfully out of this second lockdown. I'll hand over now to Joe. I know he's got some questions for both Kip and myself.
Yeah, thanks both of you for that. Yeah, really, really good overview there of the two different markets, and they're very different, but also they will work together very well. I imagine you have some people that need funding and also maybe have got a bit of recovery, but likewise, the recovery might be enough, or the funding might be enough. So really, really great that you guys can offer both sides of the coin. So we've got a few questions which are fire, and we can decide who's best to answer those questions. One of these questions, the first question I'm going to ask, was actually asked to me before this webinar by a client. So I just thought I'd ask it because it was quite interesting. So the client's taken a bounce back loan, and they're not, at the moment, they're not using it, but there is plan to use it. But one of their board members at a board meeting has said, the client, the main director, has said, I've taken this, and I've taken this because, and in their words, no risk. The other board member has said, I don't believe there's no risk at all. So yeah, Kip, I don't know if you can just explain that risk to no risk scenario.
Yeah, absolutely. With bounce back loans and CBILS, it's important to note the business is always going to be 100% liable. But I think what they're talking about in terms of the risk and where it sits is clearly it's completely free for 12 months. So there is zero risk for the first 12 months. If they need to repay it, they can at no cost whatsoever. So that risk is eliminated within the first 12 months. And there is also no personal risk. So there is no personal guarantees whatsoever attached to these bounce back loans or CBILS up to 250,000. So yeah, that's where the risk sort of comes into it. So there's no personal risk, and there's certainly no risk for the first 12 months. Clearly the business is liable, and after that first 12-month period, they will have to repay it. So it's important to look beyond that. But if you can take it, do take it. And certainly with CBILS, do take it. The penetration in the marketplace with CBILS has been so low compared to bounce back loans, just because I think there's a bit of a misconception about how difficult it is to get funding. Banks probably put a lot of people off just because of how much information and time was spent. So I think there needs to be a bit of a mindset change, and the CBILS marketplace is fully active, and it's a win-win situation. So there's just no good answer to why you wouldn't take a loan, or certainly why you wouldn't look to.
Brilliant, thank you. And that kind of answers one of the other questions, which is I don't need the money right now, and I feel like my business is managing okay, but can I still use the scheme? And like you've just said, there's no requirement. Whilst you may have to kind of discuss why COVID has affected your business, there's no requirement to show exact usage of those funds right now, is there?
No, not at all. So all alternative lenders are more than happy for you just to basically have the funds. A lot of people have just taken it and put it on a savings account, and basically it's an in-case scenario. And this is sort of what it's designed for. We were told categorically by good old Boris that we wouldn't be going into a second lockdown, and look where we are. So there is so much uncertainty that it's very hard to accurately forecast. So why wouldn't you take it? If you don't need it, repay it back. There's no need to show that it's going to be utilized in the business. It's there as an in-case scenario as well.
Comes back to that resilience funding type thing, doesn't it? So thank you. Rory, one for you on the recovery side. I have a client who's delayed paying me. Are there any upfront legal costs involved to pursue debt recovery?
Sure. So with many law firms that offer the service, there will probably be upfront legal fees, admin fees, document fees to engage. Through Nephos and through Capitalise, Escalate will engage the client directly. It's a very quick, streamlined process, and they will absorb all of that initial cost right up until the High Court, so that there's no risk for trying to recover debt using Escalate. Whereas some of the traditional methods, you are going to, at some point, whether it's when it gets to court or initially, have some kind of legal fees, which is what has put so many people off doing it. Many SMEs will just write off £1,000, £2,000, because you're probably going to have to pay £500 just to get the ball rolling.
Thank you. And just on that, there's no liability on the business to, if I've got a client who's got an issue with a customer and they believe that customer is great to pay, so Escalate look at it and go, yeah, well, cool, we're happy with it, but actually the customer isn't able to pay, there is no risk on the business owner saying, they're not saying I'm vouching for them being a good business or anything like that?
No, Escalate will do a deep dive into it. You know, if they can't, you know, if it's not recoverable because that the contracted party or the ower can't make the payment, all that will happen is that your client looking to recover the debt, they won't be able to recover the debt because the client can't pay it. There's no assets there, but they'll get free legal advice on how to set up their contracts and their invoices in the future to make sure that, you know, they can get paid on time, because then, you know, maybe something in there that's allowed a bigger company to get away with extending credit terms.
Great, thank you. I'll take the next question here. So are there any additional costs using my accountant via Capitalise than not? The answer to that is no. There's no cost to using Nephos. There's no cost to using Capitalise because you're going through Nephos. What Nephos allows you, using us to go through Capitalise, just allows us to utilize the relationships we have with the likes of Rory and Kip and the other great guys at Capitalise, and not only put that funding application through for you, but also have those conversations with the guys at Capitalise. And I think, you know, the other key part is we all, you know, mortgages are the most fun one, where we go back and forth with a mortgage advisor between the client, the accountant, and the mortgage advisor lots of different times to get lots of different documents. By using us and Capitalise, we take that pain away from you, because we'll be in contact with the guys, we'll be uploading documents, and 9 times out of 10 we'll have access to the majority of the documents we need through our systems anyway. So just streamlines the process for the client.
That's quite a good point, Joe, because many SMEs will go onto Google, will go to the first lender they see, and often that's the lender that pays Google the most. It's the quickest lender that requires the least information. So our platform together with you guys means that we can fully prepare the application and give your client, you know, complete peace of mind that they've got the right product at the right price and at the right time.
Yeah, most people wouldn't choose car insurance without a comparative site, would they? And it's the same here. Why would you choose finance without comparing your options? And that's not saying one is right or wrong, you know, and you don't always need to go for the cheapest, but why would you not at least look at the market and see what's out there?
Absolutely.
Cool. There's just a couple of last questions, guys, and then we'll pretty much be good on timings as well. So in terms of using the funds, are there any, so if we're talking C-bills and bounce back loans here, I would assume is the question, but are there any restrictions on the use of those funds? Can the banks do anything about it?
Not really, because they've got no recourse or way of monitoring how the funds are used. That's not to say that they should be, you know, drawn out of the business and taken to Vegas or anything like that. But it's just about them being utilised for business purposes. So for, you know, management buyouts, acquisitions, they're all business purposes. So if you are looking for them for a slightly niche reason, as long as it's a business use, that it's absolutely fine. It just can't be used for personal reasons.
Great, thank you. And then the last question, again, probably for you, Kip. Have a bounce back loan, but want to apply for C-bills. How would that work, and is that possible?
Yeah, it's absolutely possible, and that's what 99% now of all our clients are doing, purely because the bounce back loan market, you know, there are 1.4 million SMEs with, I think, 3 or more employees. I think there's now been pretty much exactly 1.4 million bounce back loans taken. So the market is pretty saturated for that. So yes, you can absolutely take a C-bills. If you have a bounce back loan, it just means that the bounce back loan has to be repaid at point of drawdown. And that's obviously your responsibility as a business owner to ensure that takes place. But like I say, they're all comfortable lending when people have bounce back loans, because it's just where the marketplace is. You'll just have to refinance the bounce back loan, because you simply can't have the 2 government products at the same time.
Great, thank you. And I've just got one question. This is a question that I've just come up with in my head, actually. But the selective invoice, like I say, invoice finance is a very difficult subject. We're actually at Nephos, it's something we know quite a lot about, given my background in industry and a couple of other members of the team. We've used invoice finance quite a lot, and your point around it being a kind of dirty word is definitely seen. I had these conversations a few years ago with clients. But on the selective side of things, are there many people that are in that market?
Yes, there are. There are a fair few out there. There is one who is able to look at it on a CBILS basis. So yes, you can either have it through CBILS or you can have it through normal selective. But yes, there are lots of lenders out there. The invoice finance market is incredibly crowded and competitive now. So what maybe you might have thought was a cost of an invoice finance facility, it's reduced substantially in the last 5-6 years. Hugely. It's a much more open, flexible, competitive product. So absolutely, there are selective lenders out there.
Fantastic. Cool. I don't think there's any last minute questions. So yeah, thank you very, very much. Thank you everyone for joining. It's been really interesting to hear these insights, and anyone's got questions around funding that they want to talk to us about, or any kind of advice around their business, building resilience and growing through these times, please get in touch with us at Nefos. We're at www.nefosaccountants.co, or drop me a line on joe@nefosaccountants.co, and we can get you in touch with the guys at Capitalise as well. So any final words, chaps?
No, just a thank you from you for having us, and yeah, thanks very much.